The Bushwhackers.
He's doing the dance. Good morning, Tim.
It's the Bushwhackers. Tim knows.
Good morning.
It's our Tim Quast dance now. We have a specific dance for Tim Quast because he gives us so much great information all the time. So that's my dance. It's my Tim Quast dance. I stole it from the Bushwhackers.
Love to see it. Happy Monday, guys.
This is it. That's all I got.
Happy Monday.
Back at you.
Our general sense of things is everything right now is sort of in the limbo as we wait for the next headline to come from Ukraine/Russia or from the Fed. What is your take on things here?
Well, options expire this week. Things like that get lost in the shuffle, and I continue to say that we tend to assign meaning to what the market is doing based on what we can immediately see in front of us. So, the futures are way down, and all the headlines are everybody's concerned about Ukraine or the Fed, and then suddenly the futures are up, and then we root around for some reason to explain why they are, and we say, well, it's Sergei Lavrov who eases everybody's fears that there will be war in Ukraine. And I'm not sure how much of that is actually true, because if you look at the behaviors, you would conclude that there's not very much rational thought to it. Looking at Market Structure Edge, we said it's Market Structure Monday, so we talk about the mechanics of the market. Active money didn't lead the market down 2 days last week. The reason the market was down the last 2 days of last week was because short volumes remain very, very high. That's, the market's long or short, and it's 47.53%. 47% is very high, and passive money was a modest seller. If you look at the last 20 trading days, 10 of them prices were above midpoint, 10 of them prices were below midpoint. That's very much the behavior of exchange traded funds. So if you have high short volume and a perfect balance in supply and demand, prices will go down. So I realize that that's not nearly as interesting as wringing one's hands over what may happen in Ukraine or what the Federal Reserve says. But I'm also reminded of Will Rogers, who said, "Don't let yesterday consume too much of today." And I think that we want to look at what may happen in the next 2, 3, 4 days into options expiration.
So, that's what matters, and expectations matters. And I feel like your system is just a feel for where market expectations really are. Yeah. So, that is what everything is about. It's expectations, and then meeting or exceeding expectations. It's not about the absolute numbers. It's all about, what the market is feeling and how they're feeling towards certain sectors and certain stocks. So can we jump into your, let's look and get a feel for, what you think's happening this week. We're coming into the back end of earnings season, but there's still some big companies reporting. I'd love to see what the market structure is looking like on NVIDIA.
Okay, we can do that.
It's going to be messy. I'd say
sloppy.
It's going to be like a 4.
4.
Well, let's throw out our predictions here. I think it could be higher. No, you're right. It's been messy. Let's look at. I don't know. I don't even know what to predict. It's a tough one. Where is it?
It's actually a 10.
What?
It's a 10. But you want to know when to buy or sell it, right? So that's always the case. You want to know when you should do something, traders. And by the way, for those of you who are unfamiliar with Market Structure Edge, it is a way to incorporate the mechanics of the marketplace, the physics of the stock market, the regulations, the rules, the behaviors, into how you think about what prices will do. And we think about supply and demand. So the top graph shows you NVIDIA, the closing price relative to its underlying demand. And then the bottom graph is supply. The supply chain of the market is borrowed stock. It's the way that the stock market works. So NVIDIA delivered some decent gains. So here's last Monday when we talked. And so you would look at this and say, well, demand is rising and supply is level. The trend isn't great, but if you're talking about the short term, 4 or 5 days, that will produce some gains. Once it gets to 10, then the probability of gains begins to diminish. There's no question that the market behaved oddly Thursday and Friday, but this tells us now I mean, would you want to be in a stock that is 10 out of 10 and 60% short heading into options expirations? Not generally. I'm not saying that something surprising couldn't happen, but I would look at this and say that NVIDIA, if you traded NVIDIA, you want to be gone now ahead of options expirations.
I mean, the risk, isn't that the problem with this market overall and why we continue to be weak here right now? Because market participants are seeing risk from multiple places. You know, we're seeing risk from Ukraine. We're seeing risk from, obviously, interest rate, you know, a tightening environment. I mean, it's just like the market institutional money seems like it's a little more risk off right now. And I mean, you even say, do you want to be long into the option expiration? I was like, you got a great point here. I mean, we got a lot of unknowns in the macro and the picture here. And then, you know, you have an option expiration coming up here. It's a tough sell to say why I need to buy stocks today.
I agree. And if you're going to buy stocks, buy cigarettes, because
are the Philip Morris doing well?
You'd be a lot better in Philip Morris than you would in tech stocks.
Yeah. Everybody smokes when the stock market's going down. Everybody starts smoking. I consider smoking some days.
Exactly. And even Philip Morris isn't great from a supply side because the short volume is well above trend. But in the short term, as prices fell in the broad market, supply fell in Philip Morris and demand rose. Well, that's what you want to follow. Who cares what prices are doing or what the sentiment is in the market or what things are concerning investors? You want to find things, traders, where there is a supply-demand divergence. That's what you want. And notice that Philip Morris has been a 5 or better the entire 30-day period represented in this graph. And look, we prefer Micron and NVIDIA and Tesla. Those are much more interesting stocks. But if we're interested in making money, then we have to go where the money is. And there you have it. That's the stuff that you want to own right now. That's what you want to look for. If I look across the dashboard, so the dashboard for folks who don't use Edge will tell you what all of the money is doing all of the time. It can be as narrow as airlines and cruise ships. Why did they do well last week? One of the top performing stocks last week was Carnival Cruise Lines. And you can see the demand side was strong and the supply side was constrained. Well, as soon as that changes, and it already has, then you move on. But you can see where all of the money is. And I look across here at the demand side, and the demand curves are just not very good. And all of the supply trends are up. If the supply trends are up and the demand curves are not, prices are going to have a hard time rising. I do think, because this is typically what happens, that you get some opportunity for gains no matter what happens into options expiration. So there's volatility expirations Wednesday. That's not just VIX, but the whole volatility as an asset class set of derivatives that expire. Then Thursday are AM dated index options expirations, and then Friday are the what we call classically the triple witching expirations. So there will be some money that chases stuff up into that. But you certainly want to look to see what the demand curve is to see where that money is going. I'll give you an example. So if I look at Benzinga, Happy Valentine's Day, February 14th, where is money likely to go? Well, out of this group, if you looked at Philip Morris, Halliburton, great energy stock, I mentioned it last week, Tesla, Travelers, would you pick Tesla or Travelers right now? Well, let's just look at the two. Here's Tesla. It's a 7, topped, 46% short. The trend is up in short volume. And then you look at Travelers. Travelers is a 9 and top, but short volume is half that level. It's trending up too. If you're going to pick something out of that group late in a cycle like this, you're going to take Travelers over Tesla. It's just, you have to look where the money's going. And there's the supply-demand divergence. It's not great. I'm just saying that if you're looking at two very contrasting things like Tesla and Travelers, you always want to increase the opportunity, the probability of gains, and that's what you would pick instead. It's not the thing that I would necessarily pick. I'd pick Philip Morris. That's I told Edge users, if you're going to pick something to trade into the the uncertainty of options expirations, it would be things like Philip Morris.
What about? Oh, no, I guess that. Well, yeah. Can you look at MO while you're at it?
Yeah.
Yeah.
ML.
MO.
MO.
Yeah,
Oh,
let's see.
sure.
Because
Yeah,
Philip Morris is running, but
Altria.
Altria has just been sitting kind of hanging. It almost looks, the chart actually looked pretty decent, to be honest. Like you got the chart, little cup and handle going on. It's a defensive stock. Everybody smokes when the stock market starts going down. I don't mind the MO setup here. What? Let's get some confirmation from Tim, though.
Right. So there's only one difference between the two. So Philip Morris and Altria both have spent the entirety of the trailing 30 days at or above 5 from a demand side. See this? Right here. This is the green part, and this is the price, closing price. So that tells us that is a low volatility choice. All that big money out there, the BlackRocks, Vanguards, and State Streets that are tracking a low volatility income generating portfolio own this. But the reason it hasn't done as well as Philip Morris is the supply side. That trend is up, and it's 52% and continuing to trend up. So that tells us that there are not long bets in MO into options expiration. Still a very good stock to own during periods of volatility.
You said there are long bets?
There are not. So if we contrast, let's look at PM. So how do we know that people are buying calls on Philip Morris? Well, the supply side will tell you, even though they're very close to the same levels, the fact that this is declining when we're 5 days out from volatility options expirations. The very common Goldman Sachs technique with options is to buy 5-day out of the money calls. All right, well, that's happening here. That's what's happening. It doesn't absolutely mean that will produce a gain in Philip Morris, but it's a pretty good bet. It's a pretty good probability. And how do we know? Because the supply side's coming down. Mechanically, what that means is that Goldman Sachs, looking at its exposure, I'm just using them as an example, they're saying, okay, there is more interest in being long Philip Morris than short it, so we will follow through and do the same thing to hedge our exposure. They're going to follow that direction to hedge themselves, and you can see it.
I mean, if I'm looking at this Mo chart here, I mean, well, first of all, the Philip Morris looks a hell of a lot better, right? As far as
okay.
right?
Yep.
I mean, for me, it's all about $52 here. I mean, I don't know when this thing is going through 52. What's at 52? But you go all the way back to the middle of 2019, and that has put a cap on the stock to the up and down. So it's still $2 away. I mean, that's what I'm looking at. I mean, if you want to play it for a $2 move, yeah, but I mean, it hasn't moved. It hasn't broken out. It's just a real good level if you're trading at either long or looking potentially to exit a long or a potential short. But that's a long-term chart there, indicating major resistance at 52.
Could be. What I think about, and I don't get there all the time. I don't think anybody does. I think about 1% a day. If I could get 1% a day, what an awesome return that would be across the year. Of course, I'm only trading a small, maybe 30% of the trading days. But if you can deliver that, you can produce 100% return in a year. So often we don't think about the significance of finding something that has a high probability of giving me 1% today and tomorrow and the next day. What stuff is going to do that? It's not a sexy approach to the market, but it is a highly profitable, low risk approach. And one of the ways to do that is to make sure, particularly during periods of duress in the markets or geopolitically or economically or from a monetary policy standpoint, is own stuff that's at least 5 and has constrained supply, because that's very likely to do better than everything else. And it's not sexy. It's just effective.
The best strategies are not sexy, though. Like, I've been in this business for 22 years, and if somebody watched me trade, they're like, holy crap, is this boring? Honestly. Like, I make a lot of trades, but they'd be like, you're not flying in these things, and your P&L ain't blowing all over the place and riding, and, like, that's what everybody envisions. They envision, like, the gambler, and you're like, you're making millions and you're losing millions and you're all over the place, and and it's more just
that's no fun.
grind.
Right.
It's grind. This is what if you were to see how Citadel, it's a billion trades all grinding out a small little fraction of a cent on every single one, grinding the market makers, grinding that spread, making the pennies, making a penny, making a half a cent, making a quarter of a cent, just grinding, consistent though.
That is exactly right. There, a fellow who used to be a specialist on the floor that I've known for many years, he said when Citadel bought their floor operation, so this is a little weedy discussion, traders, but we're talking about the specialist system on the New York Stock Exchange floor and what has replaced it. And those are high frequency traders. And he said the very same thing, Dennis. He said the Citadel team came in and said the days of making 25 cents spread are over. We want a quarter penny. We want a quarter penny. The least risky behavior in the market is high frequency trading. They don't want any exposure to time.
No
time
risk.
Is risk. No risk. That's why your limit order won't fill. I did a little test for edge users last week, and I explained why you have to pay attention to the liquidity in a stock. Here's MLVF. So I just illustrated this. I said this stock, it's not a liquid stock. If I look at it in a portfolio, so let's do that, and I'll show you what I mean.
You're looking at a very illiquid stock.
Very illiquid stock, and here's the trouble with trying to keep gains and stuff like that. I will trade things only that have liquidity of $5,000 per trade or more. Generally, there are very few exceptions to that, and here's why. You can't make money. A high frequency trader won't take the other side of a trade. So you could say, well, the stock went from 1650 to 1680. Wow, I'll take that gain. That's a nice gain. The trouble is the 1.5% in a very short period of time. Well, that's great to me. However, let me just scroll down here to MLVF. Let me just search for it. The trouble is your limit order will never fill. No. You can put in a limit order over and over, and it's never going to fill. I'm wasting time here.
You can't make that spread. They've monopolized that spread. Like if it's a 20-cent spread on a $16 stock, you think you're just going to sit on the bed and sit on the offer and get filled and make that 20 cents. They'll just step ahead of you every single time. The seller comes in to sell to you. They take the other side. The buyer comes in to buy from you. They take the other side. So they jump in. There's a middleman that's jumping in and taking the fill away that you should be getting. I mean, I've complained about this, for the better part. We know, Tim, I've been complaining about this for 15 years. But they like price improvement.
It is a racket.
Drink the Kool-Aid.
This was a great discussion. Great discussion.
Before we go, Spencer, this is the thing. See this right here? This is the dollars per trade. So if you try to buy more than $1,500 of this stock at a time, it will never fill. Even less than that. So I traded 300 shares of it several times through the day, and I lost $20. But I was illustrating a point. And notice how high the short volume is, 72%. So there's no real liquidity. That's why you have to be very careful about the things that you trade. You want to keep stacking the probabilities in your favor in a market where there's liquid,
use the liquidity.
Stable,
I'm the same thing. Yep. So if you take back, and this is an important conversation, I want to keep Tim on just for a minute here. But if you take back to when I started trading and at Bright Trading in 1999, we had lots of traders trading illiquid stuff because we didn't have these off-exchange market makers that were stepping ahead of us all the time. Yep. So I traded preferred stocks. I'd make a market in small caps. I had a small cap market making algorithmic system myself that traded on the exchange. And it would sit there and make markets. And it was if the spread was tight, if the spread was 50 cents, we'd go 48. We'd tighten it up a little bit. And then there's somebody else going 46 and 44, and the spreads got tighter. But the off-exchange market makers have blown all that apart because they have the right to match they have not the right, but they have the privilege to match those orders by taking the other side. They get the first dibs. So somebody comes in and tries to buy from you, they're like, oh no, I'll sell it there. So they're always sitting there, so they can actually trade within the spread without posting any quotes of their own. It's a perfect system. So, and that's why the small caps haven't participated in the electronic trading and the tightening of the markets. We've tried to tell regulators that. It's blatantly obvious. Small caps have always been a mess. That's what they tell you, Tim. Small caps have always been a mess. Well, sure, the whole market was a mess, though. But why did the mega caps get all this liquidity? Because you got the institutional trader saying, I'm not going to trade something that I can trade $1,500 a trade on. I can never get in and out of that. For me to move in some serious money, I'm going to move that stock 20, 30%. There's no point to institutional money going into a stock like that, MLVF.
And this is what big institutions think about. This is, and here we're talking about Ukraine and monetary policy. I'm not saying those things aren't important factors, but if you want to trade profitably, which is the whole point of these discussions, then it's you can only beat the market by understanding it. And once you understand the 100%. Things that are going to harm you, then you have to at least go in open, clear-eyed, and recognize the things that are going to work against you and work in your favor. You want to stack as much as possible in your favor to improve the probability of getting a good return, or as I like to say, take gains, not chances.
Tim Quast, always a pleasure. MarketStructureEdge.com, link in chat, in description and on screen. Tim, we'll talk to you again next week. Thanks a lot.
Good to see you guys. Have a good week.